Hello, citizens of the planet Earth. This is Attila Yeşilada presenting on behalf of the Real Turkey channel. And today we're doing another video on Turkey's never ending economic experiments. If you follow Turkey, well, why else would you watch these videos, right? You might have noticed that the currency, which is the Turkish Lira, has been on a roller coaster ride. At some point, it might have been a week ago, it might have been a millennium ago, the dollar TL exchange rate jumped all the way to 18. That is, $1 bought 18 liras. And then, as I'm shooting this video, it has stabilized around 12.5. So suddenly, a dollar is only fetching 12 and a half Turkish liras. This is such wild volatility that it's like a roller coaster ride or a plane flight that has run into heavy headwinds and it's shaking like crazy, and everybody is reaching out for their puke bags. Now, obviously, people have very short memories in Turkey, like fish memories. So, the appreciation of the Turkish lira from 18 to 1 against the dollar to 12 to 5 against the dollar has led to a jubilation, with many pundits claiming that, this sly President Erdogan, he pulled another rabbit out of his hat. Let me show you these people and some of their comments. Here's a brief summary. They don't know what the hell they are talking about. Or here's another one. That's the situation of the Turkish citizens, which are stuck between poverty, volatile currency, and soaring inflation. They're running around like chickens with their heads cut off. Actually, what Erdogan has done is to save the day to buy bigger trouble in a few months' time. It may not even last a few months, but a few weeks. So, in today's video, I'm going to answer the question of whether Erdogan has averted a Turkish lira crisis. My answer is going to be no, and I'm going to support my thesis with several statements from articles appeared in the English speaking press. Essentially, I need to start with the new economic model, give a brief explanation of it, and then explain to you why it won't work and why what Erdogan actually did is jumping out of the frying pan into the fire. As you might have noticed, I know that watching my ugly mug is not is not the best way to spend 20 minutes in front of the YouTube, so I try to enrich my presentation with charts and tables of all sorts. But this experiment honestly is just so crazy. There is no way to represent it or uh, magnify it with any kind of charts or tables. We just have you know to make it up as we go along. So what is this new economic model? Remember, President Erdogan thinks interest rates are evil, which is a religious viewpoint with which I may or may not agree, and I'm sure many presidents and prime ministers around the world hold similar views. What makes Erdogan different is contrary to 300 years of economic literature and experience from hundreds of countries. He truly believes that lower interest rates will stimulate the economy and will have a negative impact on inflation. That is, he claims, if he can manage to steer the interest rates lower, Turkish inflation will fall as well. Obviously, that's a huge fallacy, but hey, he is authoritarian leader of Turkish economy and Turkey, and there is really no one to challenge him. And of course, he's surrounded by syncopaths. That's people who bootlick, who tell him, Yes, Mr. President. You're right, Mr. President. We will do as you wish, Mr. President. So that experiment was put into practice with Turkey's central bank cutting its policy rate from 19% to 14% in the brief span of 3 months. And of course, inflation didn't fall. In fact, in the interim, Turkey's CPI rose from something like 14.5% to 21.5% as of end of November. We didn't receive December data yet. And more importantly, people were really spooked because official inflation may be 21.5% or something like that, but inflation, as measured by surveys about how people feel about prices, shows it may have catapulted to 40% or 50% per annum. So essentially, anyone who has Turkish lira has a fire in his or in her pockets because its purchasing value is eroding by the day. So everyone, not only the TL depositors, but also the actors in the real economy, ran to buy foreign currencies. I mean, honestly, I forgot to put the picture here, but a few days ago, Turkish press headlined a picture of a greengrocer, and there was a price ticket. It's about dates, a favorite sweet fruit that Turks and Arabs like. It said dates, 1 kilo, $1. So imagine the financial system is rapidly shedding Turkish liras, moving to hard currencies like the dollars and euros, and even greengrocers refusing to accept Turkish lira. It got so mad, and let me show you a picture of how mad it got. I love this picture. It's one of my favorite expressions. Running around like chickens with their heads cut off. It got so mad that even Mr. Erdogan realized this is not going to work. So Sunday night, he has an address to the nation where he was in front of the cameras, and he said, okay, we're transitioning to a new economic model. We shall, that is, the state, shall secure or insure your Turkish lira deposits against exchange rate depreciation. There were other items as well which were as silly as this one, but this is the gist of the argument to stop people buying dollars so that the currency would appreciate again. And it works like this. Attila Yeşilada has a 1 year Turkish lira savings deposit at an interest rate of 15%. I renewed it today. Today is, I don't know, it's right before Christmas. So it matures next Christmas. And at the end of the first year, I will get 15 liras for every 100 lira I deposited. In the meantime, Turkish lira depreciated against the dollar by 25%. So Mr. Erdogan says, no worries, stay in Turkish lira, don't buy dollars or euros. I will pay the difference. Of course, by I, he means the treasury. So treasury will add another 10 liras on top of the 15 liras that the bank guarantees me as interest to make my total interest earnings on 100 lira deposits 25 liras, which is equal to the depreciation of the Turkish lira against the dollar. This is called, what is it called? Let me see it here. The new model, summarily called deposit protection against TL depreciation model. And I'm sure those of you who have studied economics and finance or practice it in their lives, either as academicians or business people, know that this is really disaster. Essentially, what you are doing is you are subsidizing people's interest income from the treasury. The treasury will pay the difference in interest rate to banks. And it's an open-ended commitment. We don't know how many liras of total deposits will be converted to Turkish liras to take advantage of this new scheme. We don't know whether people in Turkey who hold their financial wealth outside the financial system in dollars, gold, jewelry, etc., would come back to the financial system and deposit more liras. What I'm saying is today Turkey's total deposit base is something like 3 trillion liras, but if the scheme catches up, it could rise to 4 billion liras, and let's say at an average rate of 15% interest, the 4 billion liras will be paid 450 billion liras of deposit of interest in a year. But if, as I have provided in the previous example, in the meantime, lira depreciated against the dollar by 25%, the difference of 10%, which is on a total deposit base of 3 trillion, would amount to 300 billion liras. Roughly $30 billion would be transferred from the treasury to the banks to top up the interest income. Now you understand, I mean, $30 billion is like 4.5% of Turkish GDP and 1/5 of the annual budget for 2022. Now you may understand what a crazy scheme this is. Because if you can't control currency depreciation with the scheme and say, you know, the dollar TL exchange rate goes back to 18 as it had 2 weeks ago, the treasury essentially goes bankrupt. There's another problem why this scheme will not work. Look, why are people converting their TL savings into hard currencies? Why are the merchants refusing to accept Turkish lira and want to transact in dollars or euros? Simply because they can't predict inflation. It is inflation that Turkish depositors and the Turkish nation as a whole is seeking protection from, not the currency depreciation. And the currency depreciation does eventually pass through to inflation, but they are not the same thing. You may have 20% currency depreciation and inflation is still falling because there may be other factors like there is no demand or Turkey imports a lot of Brent oil. Let's say suddenly and miraculously the price of Brent oil per barrel declined from $74 to $25. Inflation would fall regardless of what the currency does. Or you have another drought. The farmers have not been able to plant, or the plants withered in the field, and food prices jump by 50%. Even if the lira is appreciating, you would still have soaring food price inflation. So, Mr. Erdogan targets the wrong variable to stop dollarization. Let me show you a couple of articles with links provided in this video to prove that I'm right. This is from Fortune. It says Turkey's lira leaps by more than 40% in a day after President Erdogan unveils unorthodox plan to lure Turks away from dollars. Here is the it's from Yahoo, and there a gentleman who is very knowledgeable about Turkish economics and markets, Mr. Timothy Ash, a Blue Bay asset management economist, says that this is a patch. He adds that Turkey tried a similar scheme in 1970s called foreign exchange convertible TL deposits, and it became a huge burden on the treasury, bringing an economic crash in 1979. Here's another gentleman, Russell Napier. I honestly forgot where the original article appeared, but we put an excerpt of it in our English language excerpt of it in our English language website paturkey.com. Russell Napier says Turkey's economic meltdown threatens stability of Europe, and he's completely right. Uh, And the article says it's time to think about Turkey, the country. It may be a faraway place you know little about, but it borders the European Union, has a population more than twice the size of Canada, and is about to default on a material portion of its $446 billion of external debt. You can read the rest of the article. He understands the situation very correctly and realizes that if foreign investors, those who buy Turkey's FX denominated government or private ones, realize that Turkish budget will soon go bankrupt, or the central bank, which is the agent which makes the payments to banks, run out of Turkish FX reserves, this scheme will end up in a mess. And indeed, this is from Reuters. Here is the link. It says, as lira swings, some foreign banks review or scale back Turkey exposure. You can read the rest of the article here, but the point is Turkey is a highly credit dependent country. To give an example, in the next 12 months, Turkish banks and corporates have foreign debts, FX denominated debts maturing, uh, which amount to $170 billion. And most of it is refinanced either through bond issues by private companies or banks or by what we call syndicated loans, which is a collection of foreign banks lending to Turkey in unison. And this article claims that several international banks that Reuters has contacted established severe doubts about the sustainability of the new system or Turkey's ability to pay back its maturing debt, and they are thinking of scaling their credit lines, which simply means if a Turkish bank has $100 of maturing debt and it wants to roll this over, that's refinance this debt, it will go to these banks that provide credit to other countries and say, hey, I'm about to pay you $100. I want to borrow $100 again. How about it, guys? Limiting credit lines means the banks will say, look, I'm fine with you. You're a decent bank. You run a crystal clear balance sheet, but you have a president that's completely out of line. So this is country risk. I'm going to lend you only $80. So if the Reuters view is correct, over the next 12 months, Turkey will not be able to entirely renew the $170 billion of maturing debt. Let's say a rollover ratio of 80%, that means roughly $35 billion of currency will leave Turkey. Uh, that's the madness of the scheme. So let's briefly summarize what's wrong with the scheme. A, it exposes Treasury to a liability which cannot be accurately measured at this point. That liability could be so large that it will exhaust Treasury's cash balances and even a portion of the tax revenue, so that it will go into default or it will have to borrow outrageous sums of money at exorbitant interest rates. B, what the Turkish investor and the woman on the street wants is not protection against the weakening lira. They want protection against inflation. 3, weakness in the Turkish lira is not the same thing as soaring inflation. Yes, Turkish lira weakness does contribute to inflation, but there are many other reasons, as I've described. 4, even if Turks completely subscribe to this scheme and convert all of their deposits into dollars, Turkey will still lose foreign currency because Turkey's financial situation is so precarious that foreign banks may refuse to lend to it again and instead want payment for the loans they have made to Turkey. So, when will this thing go bust? I have reviewed a wide range of economists whom I consider credible. Some say as early as at the end of the year, some say, well, Erdogan gained 3 months. My personal view is that Erdogan gained maybe a month at most. Because this is what's going to happen in January. On 3rd of January, Turkey Statistics Office, Turkstat, would announce December inflation. And once again, this is not my own estimate. I am reflecting the consensus. Inflation is very likely to jump from 21.5% in November 2021 to at least 27%, perhaps 30% as of the January measurement. That's the point when depositors who subscribed to the protection of TL deposits against currency depreciation scheme will realize that they are still losing money on their deposits because while Turkish lira depreciation may have stopped, inflation keeps going. So yes, your money in the bank is not losing value against the dollar, but that's irrelevant simply because you need that money to buy things in the future, and inflation means your ability to buy goods and services with your existing wealth is deteriorating as we speak. And then, of course, in mid January, Turkey's central bank will convene its Monetary Policy Council again. The word in Ankara is that Erdogan is determined to reduce the policy rate from the current 14% to 9%, which means, you know, people will once again start converting their TL deposits into dollars. Also, of course, right now it's Christmas or that, you know, twilight zone between Thanksgiving and the New Year's end, when many funds and banks trading positions have shut down their positions. They close their books, they are doing accounting, and they're going to celebrate their profits. But in January, when they come back, they could indirectly influence the value of the Turkish lira versus the dollar. How? They could sell Turkey's credit default swaps. When I'm shooting this video, Turkey's credit default swap is over 600 basis points, and this is the ninth highest CDS premium in the world. Or they could sell Turkey's euro bonds and corporate FX denominated bonds, thinking, as I've claimed here, and as I've provided examples from the foreign press, that neither the state nor the banks or companies will be able to repay their debts. And usually, when Turkey's CDS premiums go up and Turkish euro bonds lose value, Turkish lira loses value too. So, really, Mr. Erdogan, there are no rabbits left in your hat. You don't even have a hat left. And I humbly conjecture that this was Erdogan's last mistake. As I've said at the beginning of the video, trying to get out of the frying pan, he jumped into the fire, and he shall pay the price by losing the next elections. In the meantime, of course, a nation of 85 million people is subjected to deepening uncertainty and poverty. I wish all of my audience season's greetings, Merry Christmas, Happy New Year's, and Happy Kwanzaa, as you wish. And I beg you to get your booster shots because even though it may not cause a very severe disease, spending the holiday season with Omicron is simply not a good idea. This is Attila Yeşilada, presenting for Real Turkey channel, saying goodbye from Istanbul.